Welcome back to Chapter 3, Transactions, okay? So this is where everything that you learned from Chapter 2 is going to affect your learning for Chapter 3, okay? So let's take a look at what a chart of accounts is. So again, a chart of accounts is going to be a list of all the accounts that are necessary for you to organize your transactions, your business transactions, into the respective accounts. All right, so as you can see here, you have all of the accounts in order, right, by account number. You can use account numbers. It's much more easier to memorize a 5-digit code than it is to memorize words, right? Because you can have things like a very long word to describe, for example, cost of goods sold, right? If you can't remember cost of goods sold, right, we memorize it as COGS, right? It's shorter. So in this case, instead of doing that, it might be easier for you to memorize a 5-digit code because, again, in a typical business chart of accounts could have up to 100 different accounts. They could have about 1,000 accounts, right? It just depends on how the business transactions are being organized. So as you can see, this list right here also gives us in order based on account type, right? So in this case, your assets are going to come first, then your liabilities, then your equity, then your revenues, and then lastly are your expenses. So as you can see here, right, each 5-digit code is designated a specific number. So as you can see, the first 10,000 accounts are going to be your assets. Then the next 20,000, is your liabilities. Then 30,000 is your equity. Then 40,000 are going to be your revenues, and then expenses are going to be your 50,000. Okay. So again, that's just a way that you can take a look at your chart of accounts. So again, your chart of accounts, right? It can be built over time, all right? It's not like you have to create the chart of accounts ahead of time because, again, you can incur brand new expenses in a random time period in your business, right? So you can create new accounts over time. So it's not like it's a set list of accounts that are necessary to operate your business. No. But what you do normally see is your typical accounts that are more frequently used, such as your checking account, right? We're going to definitely use checking account. And if we sell a product to our customers, we're definitely going to allow them to owe us on an account, hence the word accounts receivable. And if we're going to sell a product, we will definitely have inventory. So again, these are just examples of what you typically would see in a normal business, and we call this the chart of accounts. So this is our means of us using the chart of accounts to further organize our business transactions, okay? And they're categorized based on account type, okay? So let's talk about the general journal, okay? So this is what the general journal would look like, okay? A general journal is going to start out by, it's just a random book, right, that allows you to record your daily business transactions. So as you can see, here are 2 examples of what a journal would look like in the general journal. Now notice this here is that you're constantly doing it as you go through your business, right? Every time you have a business transaction, whether it occurs on a daily or whether it occurs every week, you're going to record it accordingly to when the event has occurred or once you receive the proof of transaction. So again, that's what the journal is meant for, is a place for you to record your transactions. So how do we actually start, or how do we begin to actually journalize a transaction? We always begin with the date. It must be in chronological order, meaning the day that it happens, that means the next transaction either happens the following day or happens the following week, as long as it's in chronological order, meaning it's in order by date. Okay, now you can be specific if you want to add time in there, but it's not necessary, right? Date is all right, okay? Because again, you can do a whole bunch of transactions and wait till the very end of the day to record them, right? That is usually a method that most bookkeepers do, is that the transactions won't get to them till the very following day or the very end of the day. So in this case, that's very important that your transactions do go in order by date. Second thing that you're going to do is you're going to record your debits first and your credits last. So what does that even mean? Well, let's take a look. Let's break down this bottom transaction here, right? When we go through the steps of transaction analysis, which we'll talk about in a second, you're going to end up determining which accounts that you're going to be debiting and which accounts you're going to be crediting. Now, in this case, when we journalize and properly record this in our journal, we have to left align our debits, and for our credits, we indent the account. Okay, so as you can see, that's what these accounts are. That's what we are trying to debit each account. So in this case, this example here, we have rent expense, we have prepaid rent, and then of course we paid with checking, which is a credit, right? We decreased our cash flow, so we credited the checking account. So that's the rule of thumb here, is when you are plugging in your accounts in your journal. Now, here's the thing too. Now, on the top of your journal, it should say description on it. Now, usually you're going to put your accounts in there, but at the very bottom, once you complete your debits and credits, right, then you're going to write a brief description of what that transaction is. Because again, oftentimes transactions can be very vague. If I bought furniture, well, what kind of furniture did you buy? That is where you can have room to enter in a description of what you actually bought and be very detailed about it, okay? Or you can have reasons why you made that purchase, all right? Now, descriptions must follow this rule of thumb. Descriptions are going to be written in parentheses, so make sure you are aware of that, okay? So then next thing is going to be identifying your post reference. Now, if you do not use account numbers, then your post reference is not going to be there. Okay? Maybe your post reference will just say assets, liabilities, or whatever it is, right? But if you are using account numbers, that's what these post references are for. So for instance, right, we have a checking account, which is account number 10100. Where do we find that? That comes from your actual business chart of accounts. So once we identify the account itself, we're going to reference it by putting in the account number. So that's why here my chart of accounts has all the following. It's got the checking, it's got the rent expense, it's got the furniture, and so on and so forth. Right? And that's what we're going to plug into my post reference. Okay? The next section is we're going to determine the total value of what you spent. Okay, so for instance, furniture, right? I purchased my furniture for $500. That's the total value of my furniture. Right? And how much did I pay out of my pocket? I paid $500 worth of cash. Okay? So in this case, when we utilize the debits and credit system, we're treating it as if it's in terms of dollars, right? So pretend we're on that number line again, right? We're using debits and credits as if they are dollars, okay? So that's why, for instance, the rent expense, right? The rent expense is $500 per month, and then the rent that we paid in advance was $1,000, and here I spent a total of $1,500 for rent. And down below, I said I paid rent for 3 months. And here I even put a check number, okay? This is proof of a transaction, but also this identifies that the value of my money and how I'm putting them into my accounts, okay? And at the end of your journal, your goal is to make sure that your total debits equal your total credits. So in this case, 500 for rent plus 1,000 to your prepaid is equivalent to your $1,500 that you spent, okay? Your $500 that you bought worth of furniture is equivalent to the $500 that you paid in cash, okay? So again, this must hold true that when you journalize, you're balancing the debits and credits, okay? This is so then every time you run your trial balance or your balance sheet, right, that the accounting equation is always true, okay? Right? If you have an action, you have an equal and opposite reaction, okay? All right? So any questions in regards to journalizing? These are the standard steps and procedures. No. Okay? Right? And then, of course, step 5 is the description, okay? In this case, you could put the description either when you do finish your debits and credits, or when you finish putting in your accounts, you could put the description there. But sometimes if you're waiting till after you've distributed all your money, then you could put all your description there. But again, descriptions, right, are usually going to be in parentheses if you want to italicize them to make it, to differentiate between the accounts and an actual description. Your description can be as long as you'd like. But remember, your journal isn't a place for you to be super detailed into what this transaction involves, right? You just need to have the necessary components such as proof of your transaction, right? What was the contract number? What was the proof that you paid, right? With the check number. Who did you pay? Those are the usual things that you would put in your description. All right? So let's talk about transaction analysis. How do we even determine when to actually journalize, right? So there are 7 steps to transaction analysis. So this is where we're going to walk through a scenario and we're going to analyze the scenario and determine how we're going to journalize it, okay? So step 1, you need to collect your proof of transaction and you need to analyze it, okay? So again, so step 1, you're going to collect the proof of a transaction. So that could be a receipt, a contract, an invoice, a bill, some kind of proof that a transaction has occurred, whether you received items and owe it on a bill, or whether you went to the store and paid with it, whether you used a debit card, credit card, or cash, right? That's going to be considered a proof of transaction because money has been moved from one place to another, all right? A dollar per dollar transaction has occurred, okay? So that's what we have to do is we need to collect that piece of information, proof that a transaction has occurred, right? So that's step 1. So in this case, we do the example here where we bought some furniture, right? In a grand total of $500, right? So then second thing is step 2 is we're going to now understand the transaction and analyze it. So again, what does that mean? So this is where we're going to take that whole who, what, where, when, why, right? We're going to analyze it. Who did we purchase from, right? What did I buy? I bought furniture. When did I buy furniture? The date says right here that I bought it on January 1st, okay? How did I buy it? Well, in this case, I bought it, I paid with cash, so that's the how, okay? Why did I buy it? My store needs furniture, okay? So again, you want to understand what was the purpose of this transaction and analyze it. How does this affect my business? Well, in this case, I purchased furniture for my business. So therefore, I bought fixed assets. Okay? So then my business, you have a place to sit. Okay? Step 3 is now we're going to determine, okay, which accounts are going to be affected. Okay? Because we talked about how does this transaction affect my business? Well, I purchased fixed assets, right? So how is this going to affect my accounts? Well, we've already determined that we purchased furniture. We bought a fixed asset. So what are we doing? Well, I increased my fixed assets, or I increased my furniture, right? And how did I pay for it? Well, I paid for it using cash. So therefore, I must have decreased my cash. Okay? That is how this is affecting my accounts. So what happens is now I'm going to go to step 4, which is going to be determining those accounts that exist on my chart of accounts. Do I have those accounts? In this case, I do, right? This is the chart of accounts. My cash is account number 10100, and I have a furniture account for 10400, right? And they're both assets. So this is where you're going to be using your accounting model, right? We're going to determine, right? How does this, me purchasing the furniture, using the accounting model? Well, I'm purchasing an asset, so I'm increasing an asset, but because I spent money, I also decreased an asset, okay? So then now we could go to step 5, using the debit and credit system. How do we plug it into our journal? Well, like I've mentioned, we are increasing our furniture, which is an asset, but we're all at the same time decreasing my cash account because I spent the money. The money's gone. So therefore, that's exactly what I'm going to do. I know for a fact that I'm going to be debiting my furniture and I'm going to be crediting my cash. Okay? So of course, then step number 6 is going to be determining which book you're going to be putting it in. Now, in this class, we only have one book. It's going to be one general journal book. But when you go into a different company, yes, because in this case, a company is going to have separate books for separate areas of a business, right? One specifically for sales, one for specifically for inventory, right? Inventory management. One of them is going to be for HR, right? People who are doing payroll, right? And then one for just expenses. So there's going to be certain books that you may have to decide and decipher which one you're going to be putting it in, and make sure that it's the correct one. But for this class, I'm going to make it very sweet and simple for you guys and make it so that we only have one journal that we're going to be focusing on, which is just the basic general journal. Okay, there's no title to it, or it's not for a specific area of operations in a business. Okay, so again, we only have one book. All right, once you've done that, step 7 is you're gonna do it. Just like the Nike logo, you're gonna do it. Okay, you're gonna record the transaction in your journal. So there you go. Boom. I purchased furniture. I paid with cash. Those are my account numbers from my chart of accounts. I debited my furniture for $500 and I credited my furniture for $500. And my description is I purchased furniture for the shop. Okay? So again, the 7 steps of transaction analysis is key to let you know when and where to journalize this transaction. Okay? Any questions to the 7 steps of transaction analysis?
No.
Okay. Norman, no question?
No questions.
All right. Okay. So let's talk about correcting entries. So in this case, right, what happens when we have errors or we accidentally put something in the journal by mistake. Now, unfortunately, with the rules of GAAP and being governed by your federal, local, and state governments, unfortunately, if you're doing manual bookkeeping, it is wrong or it is illegal. You cannot be scratching out, crossing out, or taking a whiteout pen and erasing your transaction. Why? Because in the eyes of the IRS or the government, whoever is looking at your books, they're going to see that, and it's as if you're trying to hide a transaction from the government. So in this case, no. Even if you made a typo or even if you misspelled a word, obviously that's not going to affect your accounting itself, right? It's the numbers that's what is looking at, right? So in this case, you are actually not supposed to be able to, because it is a rule to the IRS that if you're trying to erase a transaction, what you're trying to do is you're trying to fraud the company. But of course, because we are students in this class and we're learning for this class, and the beauty of this class is we're using an electronic application, right? We're using Microsoft Excel. So in this case, yes, we can do this for practice purposes only. Make all the mistakes that you want, because again, you're not going to be professional bookkeepers at the end of this program, right? You're going to continuously making more and more and more mistakes because it takes time to master bookkeeping. Okay. Now, again, so this rule here is just for manual bookkeeping, meaning if you're going to be writing everything pen and paper, you can't scratch it out or anything. But if you're using Excel, of course, we have the capabilities to erase our work and start over. Okay. Now, if for any reason that you have found or acknowledged that you have a mistake in your journal, how do we correct it? There are two ways that we correct our journal entries. One is the reverse and re-entry method, and the second one is the error cancellation method. Okay? Let me go ahead and briefly go over what the difference between the two, and then we'll actually go over an exercise. Okay? So the reverse and re-entry method, really, you're going to actually have two entries in there, right? You're going to have one entry to reverse the transaction, okay? And then you're going to re-enter a second journal entry by entering in the same journal transaction, but this time with the corrected amount or the corrected account, whichever it is that you made a mistake on, okay? So again, the first transaction is going to be you're reversing the transaction. The second one is you're going to re-enter it with the correct information, okay? Where error cancellation only has one journal, and that is to just correct the error at hand. So if, for instance, if it's a difference in the amounts, you find the difference between them, and you have to figure out which account is over, which account is under, and correct it by adding the difference into those accounts. So this one, okay, so out of the two that you see here, I'm going to recommend this to you. For beginner users who are still not very familiar on how to journalize your transaction, you are better off using the reverse and re-entry method, where people who's been doing accounting for longer times or who actually truly understand just journalizing in general, error cancellation would be much more easier and would be less time consuming than a reverse re-entry in this case, okay? So let's go ahead and see an example of each one. So let's talk about the reverse and re-entry method. So for this example here, on September 15, you end up purchasing office supplies with cash in the amount of $65, okay? But of course, let's say just time has passed by and you're decided to record at the end of the day. And of course, sales tax is included as well. And of course, when you recorded it, you end up recording the transaction as $56. Okay, so correct the entry. So in this case, this is what you originally journalized. You originally journalized that on September 15, you recorded office supplies in cash to be $56, even though it is 65, but again, maybe you were tired at the end of the day and you just remembered it was one of these numbers, or you could have accidentally made a fat finger typo, right? So in this case, right when we understand that, now let's see what happens. So let's say I end up catching my mistake. So how do I fix this mistake? Well, let's reverse this transaction, right? Reversing it, basically what you're doing is you're undoing this transaction. So in this case, right, I'm going to reverse this transaction by reverting that. I'm going to revert this $56 worth of cash, and I'm going to revert the purchase of my office supplies, okay? Now, if you're thinking about this in real life example, right? Let's say you did go to the store. You purchase office supplies for the $65, but you end up recording it at $56. How does the reverse and re-entry method work? Well, if you need to correct it, what do you need to do? You need to go to the store and return the product. Okay, so there you go. You're going to get your cash back, and you're going to end up returning the office supplies, right? That's the reverse entry, right? Then, now that you've reversed it, everything's canceled out. Then the second one that you're going to do is you're going to re-enter the transaction, right? That you're going to purchase those office supplies, and you're going to pay cash, and now you're going to identify the correct amount. So in this case, right, we went to the store, we purchased it, then we realize it's the wrong amount. We go back to the store, refund the product, and then turn around and rebuy it. That is the simplest way to understand the reverse and re-entry method. Okay? Excuse me. All right, so this is the reverse and re-entry method. So any questions here? So that's the first method that we took a look at. So let's take a look at the second method. What is it for error cancellation? So as I mentioned to you, this one's a little more difficult because you have to truly understand the nature of how a transaction flows, right? So in this case, I know I purchased those items for $65, but in my books, I recorded it as $56. So I need to first determine what is the difference between the two numbers that I made my mistake on. If I'm supposed to have $65 worth of office supplies, but I've only recorded $56, what's the difference between the two? It's going to be 9, right? Now, I have to think about this very carefully because this is where I can also make a second mistake that I might have to fix again later on. I now need to determine which account is over and which account is under. Am I short in office supplies or am I over in office supplies? Okay? So in this case, right, I'm supposed to have 65, but I only have 56 right now. So am I short in supplies or am I over in supplies? In this case, I'm short in supplies. So therefore, I need to increase my supplies by $9, right? And then, of course, my cash. I spent $65, but in this case, I recorded it at 56. So am I short in cash or am I over in cash? In this case, I need to spend more cash, right? I'm short in my cash. So that means I need to increase the amount of money I spent by $9. So therefore, I'm going to increase my office supplies because right now it says I have $56 worth of office supplies, but now I'm supposed to have 65. So I'm going to increase it by $9. And of course, I'm also going to spend $9 extra more dollars. All right, and my description here is to correct the entry on September 15 for those office supplies. Yes.
So, like for example, if instead of the account being over, it was under,
This is this
then
example, yes.
the cash would be in the debit, and office supplies would become credit. Is that what would happen?
If okay, let's say you recorded 65 instead of 56. Let's say you actually purchased it at 56, but you recorded it as 65. In that case, you spent too much money, right? You went over the cash and you have too many office supplies. Yes, in that case, you would be debiting your cash because you spent too much cash, right? So you need to put that money back. And the office supplies is you have too many. So you need to lower, you need to decrease it. So yes, in that specific case, it would be the opposite. Okay. All right. All right. Any other questions in between in regards to correcting your journals? So again, I do recommend that you guys do the reverse and re-entry because it's much easier to understand and you're less likely to make the mistake. Because in this case, right, if I couldn't figure this out, that I had too many or I had too less of office supplies, right? And I accidentally decide to credit my office supplies, right? Then that means I made an additional mistake to try to correct a mistake I made earlier. So therefore, you're going to end up having to correct all of it anyway at the end of the day. You made two mistakes in a row for the same transaction. So again, you definitely don't want to do that. So for this class, I do recommend you to just stick with the reverse and re-entry, but just know that there are two methods that you can use to correct. And if you find error cancellation to be much more easier for you because you kind of understand it, then by all means, go ahead and use it. Okay. All right, T accounts. What are T accounts? Now, oftentimes when we use our journals, because the purpose of our journals, we are just recording day-to-day transactions, okay? Meaning, for example, right here, I'm just using cash left and right, okay? I'm not determining what my account balance is because in this case, that's not what the journal does. The journal only records daily transactions. So in this case, here we go. On September 1st, I earned money. September 2nd, I spent money. And then September 3rd, I spent money. So in this case, right, the journal is only telling me what I did with the money. It's not telling me how much money I have. So what you can do is on the side of your journal, you can create a small T account, which allows you to see how much money you have on hand at all times. Or it doesn't have to be money. It could be any account that you wish to know the account balance in. So in this case, of course, you're gonna have to look into your checking account to see actually how much money you started out with, and then you're going to go ahead and follow through, right? Okay, I earned cash, so it was a debit. Then I subtracted cash because I spent it here and I spent it there. So at the end of the day, the difference between my two balances here is going to determine what my actual account balance is now, right? So if I started out, right, if I started out with $5,278 and I have a total credit of $565, I just simply subtract the two and I get my account balance to be $4,713. So again, that's just a quick and easy way to just see what your account balance is at all times for any given account on your journal. Now, that's just, chicken scratch on your journal. And yes, you can do that. On the side of your journal, that's acceptable. But no crossing out an actual journal transaction is is an option. Okay. Now, T accounts only serve the purpose for just quick account balances. So let me talk to you about what the general ledger does. Okay. Because the general ledger, what it is it's another book, but this time this book has a list of every single account that's on your chart of accounts, and what it does is it gives you your respective account balances. Okay? Now let's take a look at what the general ledger looks like. It looks identical to a journal. Okay? And the only difference is you have extra 2 columns. You have 2 extra columns that allow you to see your running balance. And that is the difference between the journal and the ledger. One is you're recording your daily transactions. Your ledger records your current balance in every single account. Okay? So for instances, right? Here's our cash account. So again, we started on August 31st with that with $5,124, right? On September 1st, we got a sale, right? So that's why we have $5,278, right? We increased our cash flow. And then, of course, on the 2nd of September, we had to pay for rent. So that decreased my account by $500. So that's going to give me my account balance right here of $4,778. Then, on September 3rd, we bought office supplies for $65, which decreased my account once again to $4,713. So in this case, what the general ledger does is it allows you to see where you are at any given point in time after each transaction. Okay? So once you journalize your transaction, right? If you go ahead and post it immediately to your general ledger, you will know how much money or how much in each account you have at the exact moment you enter in this transaction. So that means you're going to know a running balance at any given point in time. Okay? So that's the importance that you do know about the general ledger, because it's important because it becomes part of your steps to your accounting cycle, which we'll talk about in chapter 4. Okay? So again, it is crucial to know that you don't just only journalize in a journal, okay? Because that only records daily business transactions. For most cases, you should be aware of every activity that you have, especially in checking accounts and your cash accounts. If you have a cash account on hand, you definitely need to know how much money you have in your pocket at all times, right? That should be the general business rule of thumb, because again, if you're constantly buying and selling and then you don't keep a good track record of how much money in your checking account, you might end up overdrafting your checking account by paying too many bills, or not depositing all your cash in the bank. So again, it is detrimental that you do keep a good track record of at least your checking and cash on hands account. Okay? Because that's going to allow you to see, do you even have enough money to even pay the people that you owe? Right? Should you be collecting more money for the people who owe you the money? Should you be selling more money or selling more products to earn that money? And should you make more deposits more frequently so you have stable money in your checking account? That's important for a business. Okay? So that's what a general ledger does. Okay. So course review. So once again, we talked about what the chart of accounts does. It's a list of every single account that you need to use to organize your business transaction in those accounts, right? Your assets, liabilities, equity, revenues and income account, revenues and expense accounts, right? We talked about how to properly journalize a transaction, right? You need to follow the rules of thumb, meaning putting the date first, putting your debits account first, and then your credit accounts last. You need to have a description, If you have a post reference or if you use account numbers, then put your post reference there. And the general rule of thumb is because it's by dollar value, right? Then you're going to identify, does your total debits equal your total credits? Because you need to have that necessary component in order to finish your journal, okay? Then we talked about the two correcting methods in case you make an error in your journal, the reverse and reentry method and the error cancellation. We talked about T-counts, and of course, we talked about the difference between the journal and the general ledger. They are both identical to the point where they do record transactions. Only difference is the general ledger records account balances in every single account in your chart of accounts. Okay? So, any questions in regards to Chapter 3? Okay, so let's go ahead and complete the Chapter 3 exercises here. Okay, so again, question number 1, what is a chart of accounts?
A list of all the accounts used in your general journal.
Good. Excellent. A list of all the accounts used. Good. Number 2, what is a general journal?
A book where daily business transactions are recorded.
Good. Number 3, what is a general ledger?
No, let go. A book or record of all the accounts with their respective running account balances.
Good. A book with all.
Here, you're okay.
Good. Number 4. Okay, what are the 7 steps of transaction analysis? So you don't need to be specific, but at least get the general idea. So what's the first step?
Recognize that a transaction has been made.
Good, right? Recognize. And how do you do that? By having proof of a transaction. Okay, what is step 2?
Understand how the transaction affects the business and whether it needs to be recorded in the formal bookkeeping records.
Okay, and step 3?
Determine what accounts are affected, increase or decrease.
And then step 4?
Use the business's chart of accounts to determine account numbers.
Okay, step 5?
Use debit and credit rules to determine if the accounts are debited or credited.
Debit/credit. Good. 6?
Determine what journal should be used.
Which journal? Okay, and
do it. Record the transaction.
Excellent, right? Good. Number 5, how is the general journal recorded in terms of time?
Chronologically.
Yes, it has to be in order based on the date that you have occurred the transaction. So again, chronologically. Okay. Number 6. Okay, when recording the general journal, what goes first?
The date.
Okay, after the date, because we already established that it has to be in chronological order. What happens after the date?
The transaction.
How, in what order should the transaction go? In this case, I'm asking when you're journalizing your accounts, which accounts go first?
Oh, your debits.
Yes, your debit accounts will go first. So debits go first, right? And credit accounts go last. Okay. Number 7, at the end of journalizing, what must be true?
Your debits and credits should match.
Yes. Debits equal your credits. That's correct. Number 8, what are the 2 methods of correcting journal entries?
Reverse and re-entry.
Excellent. Reverse and re-entry. And what's the last one? Or the second one?
Error cancellation.
Yep, error cancellation. Okay, good. All right, so this is why I was going to say this part's going to take a while, because this is where I need you to pull out your chart of accounts, utilize the 7 steps of transaction analysis, because for number 9, you're going to be recording the following transactions in your general journal, and you're going to be using this chart of accounts that I have provided for you. So in this case, I have account numbers, right, to help you practice with your post-reference. Here's the account names and what type they are. Again, this table is sectioned off into 2. Okay, so again, here are the following transactions that you're going to be journalizing. Okay, so the very first transaction we have here was on January 1st. You end up paying rent for $500 cash. So let's do our 7 steps of transaction analysis, right? Step 1, has a transaction occurred? Yes, it has. Step 2, how does it affect your business? Well, you paid for rent. You need rent in order for you to operate your business, right? Step 3, right? Determine which accounts are affected. Well, you used cash to pay, and what did you buy? You purchased rent, or in this case, you spent money on rent. So in this case, now step 4 says determine if the accounts are on your chart of accounts. So, do I have a cash account on my chart of accounts?
Yes.
Yes, I do. Account number 100. Do I have anything in remote to some kind of rent?
Rent expense.
You have rent expense, account number 660. So perfect. I have all the accounts that I need. So step 5 is determine what to use the debit and credit system. So in this case, am I increasing or decreasing my cash flow?
Decreasing.
You're decreasing because you're paying something off. So what are you going to use? How are you going to decrease your cash?
Debit.
Try again. How are you going to decrease your cash?
Credit.
You're going to do a credit because it's an asset, right? How do you decrease an asset? You would credit the account.
Credit.
Now in this case, I just paid for rent. So I have a rent expense. Am I increasing my rent expense or am I decreasing my rent expense?
Debit.
You're increasing, right? And you would increase expenses with a debit. So there you go. Now you know My rent expense is going to go first because it's my debit. And then I'm going to follow it up with a credit for cash. So therefore, step 6, you already know what journal that you're going to be using. So step 7, let's go ahead and journalize it. So again, today is supposedly January 1st. We paid for rent, so we established that rent is going to come first, right? Because it's a debit, right? My rent expense account is account number 660. And we determined that we are going to be debiting my rent, right? By how much? How much did I pay for rent?
500.
You spent $500 on rent, so therefore you used $500. Okay, that's going to be debited. Now we already established that we're decreasing our cash flow, and we're going to be decreasing it by decreasing my cash, which in this case is 100 for my cash account. So, because we have to use the rules of debits equaling my credits, but in this case, how much money did I pay? How much cash did I spend?
500.
You spent $500. Okay? So for this case, let's just practice getting the journalizing down, and then tomorrow we'll go ahead and, or the next day, we'll go ahead and put in descriptions. So for now, as long as we understand the debit and credit system, we're good to go. Okay, the description can come later. If you want to add it, it's up to you. But in this case, I didn't leave that much journal space for it, right? Because I just want you to get the concept down. All right. Then on January 5th, you end up purchasing inventory. 100 items that cost you $1 each with cash. So you purchased them and spent it with cash. So once again, go through the 7 steps of transaction analysis. So in this case, I'm going to skip through to 3. Okay? What accounts are going to be affected? Well, what did you buy?
Inventory.
You purchased inventory. How did you buy it?
Cash.
You bought it with cash. So let's take a look at my chart of accounts. Do I have a cash account? Yes, we do. Already established that from the previous one. Do I have an inventory account?
Yes.
Yes, you do. Account number 150. So let's do the debit and credit rule. Am I increasing my cash or am I decreasing my cash?
Decreasing.
Decreasing. So am I going to debit or credit?
Credit.
I'm going to credit my account. So that's going to go last. Am I increasing my inventory or decreasing my inventory?
Increasing.
We're increasing. So how do you increase an asset?
Debit.
We're going to debit. So in this case, I'm going to debit my inventory and I'm going to credit my cash account. Okay? And of course, here's number 7. Okay? So today's January 5th, right? We established that we are purchasing inventory. Okay? And then I purchased this with my cash. Okay? Now, in this case, how much did I spend for my inventory?
100.
We spent $100, right? Now, we're not looking at a quantity because in this case, we're looking at the value. How much money did I spend for the inventory? We spent $100, right? Because each item was $1 each. I purchased 100 of them, so my grand total was $100. So that's exactly what I'm going to put. Now, in this case, that is exactly where, if you want to put your description, that's where you can put your quantity saying that you purchased 100 units at $1 each. Okay? But again, we're not going to practice descriptions yet. We'll practice them later on. Okay? Or in this case, I guess you could put it in here if you want to. Okay? That you purchased 100 units or items at $1 each. Okay? Yes.
Is there an easy way to remember debit or credit?
Yes, your accounting model. Wait, are you talking about like where to debit your account or where to credit your account?
Yeah.
Your accounting model. Your accounting model shows you which accounts need to be increased and which accounts need to be decreased, and it tells you are you going to debit or are you going to credit the account. So again, we're not going to be professional bookkeepers at the end of this class, okay? This is for practice, okay? So this does take time to get used to, and we're going to spend 10 whole weeks practicing this, okay? All right? So here, how about you do the next one? It's January 8th. We end up purchasing a machine for $750 cash, okay? So we're going to skip steps 1 and 2 because we know it's going to affect my business. Now, what did I buy?
Equipment.
You bought a machine, right? Which is, you could consider as equipment, okay? How did you buy that machine?
Cash.
You bought it with cash. So let's take a look. Do I have a cash account?
Yes.
What kind of account? What type of account is my cash?
Asset.
It's an asset, okay? Now, do I actually have a machines account? But in this case, you identified this machine as equipment. So do I have equipment?
Yes.
Yes. And what is this equipment? What type of account is equipment?
Asset.
Okay. So now, using your accounting model, let's determine this. Did I increase my cash or did I decrease my cash?
Decrease.
You decrease it. Now, how do you decrease an asset? Look at your accounting model. How do you decrease your cash, which is an asset? How do you decrease an asset? Are you going to debit the account or are you going to credit the account?
Credit.
You're going to credit the account. That's correct. Now let's take a look at equipment. Did I increase my equipment or did I decrease my equipment? Did I gain?
Increase.
You increased your equipment, right? Because you purchased one. You gained a machine. So in this case, if you are going to increase your equipment is an asset. Are you going to debit or are you going to credit the equipment account? So that's where you use your accounting model. How do you increase an asset?
Debit.
With a debit. So that's exactly what you have to do when you're using transaction analysis. You're going to be using multiple worksheets for this. So in this case, it is the 8th? Okay. The 8th, we established that we're going to be debiting my equipment account, right? And we're going to be crediting my cash account because I paid for it with cash, right? So let me identify equipment is 160. Okay, so there we go. Now, how much did I spend to purchase this equipment?
$750.
$700.50 cash. So therefore, that's exactly how you're going to journalize it, is how much did you spend in value? What was the total value of your equipment? Well, we spent $750 for the value of the equipment, and we spent $750 worth of cash. Right? All right. You understand?
Yes.
All right. So let's keep practicing. So then again, here on June 10, you end up purchasing supplies for $56 on an account. Okay, so there you go. Here's a new word that we haven't seen before, on an account. Okay, so when you go to any store, right? If you open up an account, you're creating somewhat like a credit card, right? You have an account balance. Now, if you're going to be charging your credit card to that place, what are essentially you doing? Are you paying them now or are you paying them later?
Later.
You're going to pay them later, right? Because you put them on an account, meaning, oh, don't worry, I'll pay you when I have the money, or I'll pay off the credit card bill as soon as you send me the bill. Okay? So now that we identified that that's what that means right there, so let's understand this. What did I buy?
Supplies.
How did I pay for it? So in this case, yeah, how did I pay for it? On an account, right? We owed the store money. So let's go ahead and determine, okay? Do we have supplies in our chart of accounts?
Yes.
Okay, do we have anything in remotes to an account?
Accounts payable.
You have an accounts payable, right? No way it's a loan. You didn't borrow a lump sum money. You paid it on an account, and we use accounts payable to recognize that, because we owe the vendor, and we owe the vendor within a specific time frame. Okay? So excellent. Now, let's go ahead and determine this. Did we increase our supplies or did we decrease our supplies?
Increase.
Increase. Now, it's an asset, right? So how are we going to increase my supplies?
Debit.
You're going to debit. Good. Now, let's take a look at my accounts payable. Accounts payable is a liability, right? Since I owe my person some money for buying supplies. Now, did I increase my liabilities? Meaning, do I owe more money? Or am I decreasing, accounts payable? Am I increasing my accounts payable? Meaning I owe more money? Or am I decreasing my accounts payable? Meaning I'm paying off what I owe.
Increase.
You're increasing it. Now, how do I increase a liability?
Credit.
Excellent. You increase a liability with a credit. So therefore, I'm going to debit my supplies and I'm going to credit my accounts payable account. So therefore, let's go ahead and identify this. So it's January 10 now. We purchased supplies. And then we have an accounts payable. Was it 110? Yes, supplies is 110. Okay. Now, how much money do I was the supplies worth?
56.
$56. Okay. And how much money did I owe my vendor? $56. Okay. All right. Couple more transactions here. All right. So then it is now January 12th. All right. And you had cash sales of 25 toys for $5 each with no sales tax. Okay. So in this case, I sold some toys, okay, for $5 each. Okay. And they were cash sales. So what happened here? What did I do?
You made a sale.
You made a sale, okay? And so what was my receiving end? What did I get out of the sales?
$125.
Okay? Okay. What? $125 what?
Cash.
You got cash. So in this case, we know we have a cash account. Now, am I increasing my cash or decreasing my cash?
Increase.
Increasing. So you're going to debit my cash account. Now, I sold something. So in this case, I'm recognizing a sale. Do I have sales in my accounts, my chart of accounts?
Yes.
Now, here's the question. Did I earn my sales or am I decreasing my sales?
Earned.
You earned it, right? So how do you increase a revenue account?
Credit.
You increase it with a credit. Good. So in this case, that's exactly what I'm going to do here. So today is January 12th. We received cash and we sold stuff. Okay? So again, cash is 100 and I believe sales was 410. Okay? Now in this case, how much money did I collect from the sales? If I sold 25 items and they were $5 each. $125 cash is what I earned, and that's how much I sold. Okay? And of course, you can make a note here saying that you sold 25 toys. Right? That could be your description. Okay? So then, now that I recognize that I sold something, now here on January 12th, the very same day, it now says that you need to adjust your inventory for the cost of the items that you sold. Okay? So in this case, I have to adjust my inventory. That's what happened here. So, how do I adjust my inventory?
Inventory.
Correct. I'm going to be utilizing my inventory, right? What other accounts? What is an account that represents me calculating the cost of what I sold?
Cost of goods sold.
Cost of goods sold. So let's go ahead and determine. Am I increasing this cost of goods sold or decreasing?
Adjusting it.
You are adjusting it. So if I'm, okay, let's answer this question first. Now, because I sold my items, is that me increasing my inventory or am I going to decrease my inventory?
Decrease.
You're decreasing it. So because this is an asset, that means you're going to credit the inventory account. Now, the equal and opposite one is going to be your cost of goods sold. Now, in this case, We also said that an expense account could also mean that you're trying to get rid of your inventory, right? Because they're directly correlated to each other, right? So in this case, am I getting rid of my inventory or am I increasing my inventory?
Getting rid of it.
You're getting rid of it. So therefore, are you going to increase your cost of goods sold? Yes. So therefore, let me see. This is 600, which is an expense, right? You're going to increase your expenses with a debit, and you're going to decrease your inventory. Okay, so that's how you're going to adjust it. So you got a cost of goods sold, and you have your inventory account. Now, let's determine this, because this is how you have to understand, okay? Now, what did it cost you to purchase this inventory? Do you remember? How much did it cost you to purchase the inventory?
$100.
For how many items?
100.
For 100. I only sold 25. So how much would it cost me to sell only 25 items? It will cost you $25, right? Because they're $1 each. That's what it costs you to sell those items. And that's what you're going to get rid of from your inventory. Is you're going to get rid of $25. Excellent. Easy. Okay. Last transaction here is on January 15. You borrowed $5,000 from the bank. Okay? So what did you do? Yes.
How come the toys that we bought for $1,
Mm-hmm.
our inventory of items isn't the same thing as the 25 toys for $5?
Because remember, what is the purpose? What's the nature of a business?
To make a profit.
Exactly. It cost me $1 to buy each toy, but I'm turning it around and selling it for $5. What is my goal there? I made a $4 profit for every toy I sold. Now, in this case, the purpose of accounting isn't to actually calculate what your profit or what your selling price is, because that's not what your job is. You're not the profit manager. This is just a price point that I just set up. But in this case, that's why there's a huge difference, because we want to make sure that when we sell our products, we sell it for a higher price for what it cost me, because my goal is I want to make a profit. So that is exactly why there's a huge difference between what I have available on hand and what I'm going to do with that money or with that inventory and sell it to my customers for a higher price. And that's business for you. Yes.
I kind of get the idea that it would make sense since we sold 25
Mm-hmm.
and it was $125 dollars total profit.
Uh-huh.
That the inventory would be debited by $25.
Why would you increase your debit? Why would you increase your inventory? You just sold it. You don't have it anymore. Right?
Yeah,
Because, okay, so originally you purchased 100 toys right now, right? So you have 100 toys in your inventory. You end up selling 25 of them. But in your records, because you didn't adjust it yet, you still have 100 toys in your inventory. Is that true?
no.
No. So this cost of goods sold account is a way that we adjust our inventory, right? We'll talk about inventory in chapter 5 and chapter 7 and 8. So in this case, that's how we get rid of our inventory off of our books, because we need to transfer saying that we got rid of those items. So right now, because I made that adjustment, I actually only have 75 toys left on hand, which is true, right?
Yeah.
So that's how you have to understand why this adjustment isn't increasing my inventory, because at the end of the day, I got rid of those 25 things. They're no longer in my shelf for me to sell. They're gone.
Is that what we just put? 75?
In this case, we're just learning to just understand just journalizing right now. When we move into chapter 5, that's when we'll talk about quantity. What do you have left on hand? What have you sold? And etc. Because right now, we're just practicing on just understanding a transaction and practice journalizing right now. So that's for chapter 5, which is next week.
But still, it just kind of feels like it would, instead of 75 inventory, it would be 25 credit then, because it was decreased.
And that's exactly what we did. We credited our inventory for $25.
Oh, cool.
Yes. Yes. So here we purchased it, meaning we increased our inventory, right? But because we had to adjust because we sold 25 units, we need to do something to make sure that we get rid of it off of our books. So we made our adjustment entry, right? And took off those 25 toys off my inventory. But on the other hand, right, when we talk about inventory, that's where we keep track of it, right? We started out with 100, we sold 25, so how much should you have left? Then that's how you figure out that you should have 75 left. But right now, we're just focusing on just journalizing. So yes. Okay. So going back to this. So then on January 15, we borrowed $5,000 from the bank. So what did we do? You borrowed money from the bank.
You got a loan.
You got a loan. And what does that loan come with?
Liability.
It comes with a liability, but what do you get out of the loan?
Cash.
You get money, you get cash. So in this case, we already know we have cash account, and we identify that, yes, we do have a loan. Now, let's answer the question. Am I increasing my cash flow or decreasing my cash flow?
Increase.
You're increasing, so you're going to debit that. Now, are you increasing a liability because now you owe the bank money? Or are you decreasing the money because you're paying the bank money? No. Good.
Increase.
You're increasing it. So therefore, how do you increase liabilities?
Credit.
With a credit. Good. So therefore, that's exactly correct. Today is the 15th. We received cash. And we took out a loan. What was my loan account again? $250. And how much money did we get out of it? $5,000. Okay? Good job. Now let's spend a couple more minutes just to finish up this last transaction here. Okay? So, number 10, using the transaction on January 10 from above, okay, you recorded that the supplies were $56, but then on January 20th, you realized that that was an error, and that, of course, when you bought the supplies, they were actually for $65. So let's go ahead and record using both methods. Now again, rule of thumb here is when you do an error cancellation, you only needed to choose one of the two methods. You don't do both of them, okay? Because then you're correcting an error and then you're making an error. So in this case, rule of thumb is you only use one of the other two, but I want you to practice both of them so you understand how to do it. So let's go ahead and do the reverse and re-entry. So the original transaction was you purchased your supplies on an account for $56. Okay? And now that you found out on January 20th that that wasn't true, you actually spent 65. So, how do I do the reverse and re-entry?
Can we scroll back up real quick? So the supplies would now be a credit instead of a debit.
Correct?
And the accounts payable would be a debit instead of a credit.
Correct. So in this, therefore, that's correct. You're going to reverse the transaction by returning the items. Remember, if you think about it in real life, right? You're going to return the items for the $56 that you originally purchased it for, right? And supplies. Okay. All right, and of course, you'll put to reverse the entry. Okay. And then now you need to re-enter the transaction with the correct amount.
So the supplies would be first.
For how much?
65.
Good. And then you're going to also put in
Payable would be a credit.
good. And of course, what you're going to do here is for your description, you're just going to write to correct the error on January 5th. Was it 15?
It was the 10th.
It was the 10th. Thank you. Okay. So that's reverse and reentry. Now let's do error cancellation. Okay. So today is June 20th, right? Let's identify the difference between the two. If I was supposed to record it for 65, but I end up recording it for 56, what's the difference between the two? $9, right? 65 minus 56 will give you $9. Okay? Now, we need to figure out which account is over and which account is under. Okay? So in this case, did my original supposed to be 65 instead of 56? Am I over in supplies or am I short in supplies? Short, right? Because I originally only put, or I put in there for only 56 when my original purchase was actually 65. That means I don't have enough supplies. So I need to increase my supplies by $9, right? And is my amount that I owe to the vendor, am I short in owing or am I over? Short, right? Because I owe them $9 more than what I recorded. Okay, good. All right, and that is it for today. So thank you for sticking around and thank you for extending the time here. We finished the exercises.